Crypto move fast. Stay ahead with the Bit Insight. Bitcoin, blockchain, and crypto insights. Tokenomics Unveiled. TVL, airdrops, rebasing, and real case studies. Welcome back to the Bit Insight. In part 1, we covered the structural foundations of tokenomics, from supply mechanisms to governance logic. In this part 2, we go beyond the basics. We'll explore DeFi liquidity incentives, the rise of synthetic dollars, the mechanics of rebasing, and how airdrops and curated registries are used to build hype and loyalty. Then, we'll break down a real-world case study, UNI versus Luna versus ETH, who got it right and who didn't. Let's continue the journey into how crypto projects create and sometimes destroy value. TVL and liquidity incentives. TVL, or total value locked, is a key metric that represents the total amount of capital, typically in the form of cryptocurrencies, deposited into a decentralized finance (DeFi) protocol. This includes assets provided for lending, staking, yield farming, liquidity provision, and other on-chain financial activities. In many ways, TVL serves as a measure of trust, adoption, and financial health within the DeFi ecosystem. A higher TVL usually indicates that more users are willing to commit their funds to a platform, suggesting stronger confidence in its security, returns, and long-term viability. It's often used by investors and analysts to compare DeFi protocols and gauge their competitiveness. To boost TVL and attract users, many projects implement liquidity mining or yield farming strategies, offering native token rewards to users who stake or lock their assets in smart contracts. These incentives not only help bootstrap liquidity, but also encourage active participation in the ecosystem. However, it's important to note that artificially inflated TVL through unsustainable rewards can be misleading. If incentives are too generous or not tied to real utility, users may withdraw their funds once the rewards dry up, leading to sudden drops in TVL and long-term instability. Synthetic dollars and rebasing tokens. Synthetic dollars are crypto assets that aim to mimic the value of traditional fiat currencies, like the US dollar, but without being directly backed by cash reserves. Instead, they're collateralized by other cryptocurrencies, often through over-collateralized smart contracts. A prime example is DAI, a decentralized stablecoin issued by the MakerDAO protocol. To mint DAI, users lock up crypto assets like ETH or USDC as collateral, ensuring that the synthetic dollar maintains its peg through on-chain mechanisms and incentives. This model offers the benefits of a stable medium of exchange without relying on centralized custodians. Rebasing tokens, on the other hand, take a more experimental approach to price stability. Instead of being collateralized, they automatically adjust the total token supply in response to price fluctuations. If the market price drops below the target, usually $1, the protocol reduces the number of tokens in each wallet, supply contraction. If the price rises above the target, it increases the token count, supply expansion. This mechanism, known as elastic supply, aims to balance supply and demand to stabilize the price. However, rebasing can be confusing for holders. Although the total value of their holdings may stay the same in dollar terms, the number of tokens in their wallet constantly changes, often leading to misunderstanding, price volatility, and unpredictable trading behavior. While both synthetic dollars and rebasing tokens strive for stability, their underlying mechanics and risks differ greatly. Rewards, airdrops, and curated registries. Crypto projects often rely on rewards and airdrops as powerful tools to incentivize early adoption, build community engagement, and jumpstart network effects. These strategies distribute free tokens to users based on certain behaviors, such as using a platform, holding specific assets, or participating in governance. Airdrops can be unannounced surprises or carefully planned distributions, often targeting wallets that meet specific eligibility criteria, like having interacted with a protocol during its beta phase or belonging to a curated list known as a Sybil-resistant registry. Some projects design retroactive airdrops, rewarding users after the fact based on past on-chain activity, such as trading volume or staking behavior. Others use gamified reward systems, offering missions, quests, or leaderboards to encourage participation, deepen user engagement, and increase TVL, or on-chain interactions. While these methods can accelerate growth and attract attention, they also come with trade-offs. In many cases, they draw in airdrop hunters, users who interact with protocols solely to qualify for rewards, then immediately sell the tokens and leave the ecosystem. This behavior can lead to short-term volatility, undermine community building, and distort genuine user metrics. To counter this, more advanced projects are developing loyalty-based or contribution-based airdrop models, rewarding users based on sustained activity, meaningful engagement, or governance participation, rather than simple wallet snapshots. Case studies. Good versus bad tokenomics. Let's look at a few real-world examples to understand how different tokenomics models play out in practice. Uniswap's Uni token is primarily a governance token, giving holders the right to vote on protocol upgrades, fee distributions, and treasury allocations. While it doesn't have direct utility like staking or earning yield within the core protocol, its value is rooted in giving the community control over Uniswap's decentralized development roadmap. This clear governance utility has helped UNI maintain relevance as the protocol grows. In contrast, Terra's Luna token was part of a highly complex and risky system tied to the algorithmic stablecoin UST. Luna's role was to absorb volatility by being burned to mint UST and vice versa. While the model was designed to maintain UST's dollar peg, it lacked adequate safeguards. During periods of high volatility and loss of confidence, UST depegged and Luna entered a death spiral. Massive amounts were minted to defend the peg, causing hyperinflation and ultimately total collapse of the ecosystem in 2022. This is a prime example of how flawed tokenomics can lead to catastrophic failure. Then there's Ethereum, which has taken a more adaptive approach to tokenomics. Originally based on proof of work, POW, Ethereum transitioned to proof of stake, POS, via the merge in 2022. This drastically reduced ETH issuance and improved energy efficiency. Additionally, the implementation of EIP 1559 introduced a burn mechanism that destroys a portion of transaction fees, giving ETH a deflationary component. These upgrades reflect Ethereum's commitment to refining its economic model in response to changing network needs and user behavior, making it one of the most resilient and forward-looking token economies in the space. Final insight: why tokenomics matter. Tokenomics isn't just about numbers. It's a fusion of game theory, behavioral psychology, and financial engineering, all encoded into smart contracts. It governs how value flows, how users are incentivized, and how power is distributed within a decentralized ecosystem. Great tokenomics align incentives across founders, developers, investors, and users, building trust, sustainability, and long-term engagement. When thoughtfully designed, tokenomics can cultivate strong communities, drive meaningful participation, and enable decentralized governance. But when poorly constructed, such as overly inflationary models, misaligned incentives, or opaque allocations, it opens the door to speculation, pump and dumps, and eventual collapse. That's why it's critical to analyze token models before investing. Look beyond the hype, examine the token's supply mechanics, vesting schedules, utility, governance rights, and how it fits into the broader ecosystem. If you found this breakdown helpful and want more clear, research-backed insights into how crypto really works, don't forget to subscribe to the Bit Insight, your guide to decoding the future of digital finance. See you in the next video.
Disclaimer: this video is for educational purposes only and does not provide financial, investment, or legal advice. Bitcoin and cryptocurrency investments carry risk. Always do your own research before making financial decisions.